Aloha, I'm Christopher Borden, and first off, I want to send a big mahalo for you purchasing the Ultimate Real Estate Investment Calculator. Your trust into it is really greatly appreciated, and I'm excited for you to discover just how transformative this tool can really be. Now, this calculator isn't just any calculator, it's designed to be a comprehensive solution for all of your investment needs, whether you're doing a fix and flip, you're looking to buy and hold, the BRRRR method, or you're looking for short-term rentals. This tool will definitely have you covered. Now, I know a tool as robust as this can seem a little bit daunting putting together this tutorial. I'm going to walk you through step by step so you can start making smarter, better financial decisions. So let's just dive in and unlock the full potential of your real estate investments. So first off, once you've downloaded the purchase, you'll receive a letter similar to this, just thanking you for your purchase. The first thing you're going to do is go ahead and click on this link. Once you click on the link, you're going to see this investment calculator come pop back up. However, you're also going to see in the top right hand corner, you're going to see use template. You're going to want to click this button and download yourself your own copy of the particular calculator. Okay, so now let's just kind of dive right in and go step by step on how this calculator will work and the benefits it can bring to you. So first off, you're going to notice there's some color coordination to the calculator. Most of the information that you see in yellow is where you're going to actually be inputting the requested information for you to come up with your calculation. So the calculator is sectioned off, and there's several tabs on the bottom that you can see. It's the first default tab will be the calculator. So first off, you're going to look at your property address, your MLS number. If you need it more times than not, you will not need this, and then the parcel number. You're going to want to put your year built and the square feet. This is important because it's going to tie into the calculation of the rehab or renovation. You're going to want to use what the price the property is listed for, and then you're going to have to estimate what you think the after repair value is. Now, this tool does not yet have an after repair calculator input into here. So this is the after repair value will need to be done outside of the calculator. But however, once you have the after repair value, it will be able to calculate every other use case that you need. So really understand that probably the three most important components to a successful real estate purchase is really what you're buying it for, the amount of renovation you're going to put in the property, and then based off of that renovation, what do you think the value, the market value, or after renovated or repair value would be for that particular property? So we'll move on in sequential steps. The next area or step in the process after you figured out what your after repair value would be is to figure out what kind of renovation I'm looking at. Now, obviously, with this, you're going to need a little bit of experience to understand the type of renovation you're doing, but we've made it a bit easier for you to do. So, from the standpoint of super back of the napkin, high level, you can easily just switch to the different types of renovation you're going to do, from light renovation to a full gut renovation. And you'll see as I change the metrics of the type of renovation I want to do, the overall cost of the renovation will go up. Now, as I explained to you earlier, if I have, just say I have an older property that I'm renovating, I can almost assume, and this is not always the case, but we're going to use the assumption that an older property will have more things wrong with it or more things that I'd have to renovate. So you can see as your square foot goes up, your square footage goes up, and as the vintage of your property changes, so does the full value of the renovation. Okay, and then so on and so forth with the different types of renovation that I'm putting in. Okay, now the last one we have here is a repair estimator. Last thing that we'll be looking at is the repair estimator. Now, I'll definitely go in detail about this a bit more as we get further along in the tutorial, but you can easily select this repair estimator. It's actually going to take the data off of this tab and input that into your sheet. You could also, if you look to the right, we have the repair per square foot, so the renovation per square foot cost. You can overwrite this entire thing by putting another number in here. So it could obviously be higher or lower, and it's going to recalculate the overall renovation costs and then any contingencies that would be in there. Now, it's simple to remove this. All you have to do is make sure that this cell is blank, and then it'll go back to using any one of these drop downs as the calculation for the renovation. Moving on, next thing we have is your monthly property insurance. So you're going to have to get this quote yourself. You have your HOA expenses, any utility expenses you're going to incur while you're renovating the property, your annualized taxes, as well as the estimated time for you to complete the project. Now, next we look at our closing costs. So our closing costs on purchase and then our closing costs on sale. So our closing costs is typically going to be title fees. Our selling costs are going to still be title fees, but you're also going to have the buyers and sellers, the agent's commission included in here. So normally on the sell side, you're typically going to be higher. But again, this is predicated off of sort of where the market's at. Next, you're looking at what is your offer price. So how high should your offer price be, or how low should the offer price be, predicated off of basically your exit strategy. So now you're sort of looking to see how much money I'm going to make, which I didn't explain earlier in the video, but everything is green that you see on the sheet is going to be your profitability. So here I can make some adjustments. I can say, so this particular cell is the percentage of the after repair value. So as I'm adjusting this, I can go 70%. You have the 70% rule of the after repair value. So my offer price would be $262. I can overwrite the entire offer price by just putting a number in here, and then it'll overwrite the entire offer price. So to undo that, I just hit the clear button, and then it'll factor in what my offer price be. Now, based off of the offer price and the percentage, I can quickly see my different profit scenarios. And I'll explain what these scenarios are, but I can quickly see the different profit scenarios depending on what I can offer. So at this way, if you had a minimum baseline that I needed to make 50,000, I know that I can offer 80%, probably a little higher, maybe I can go 82%, and still be able to be competitive on my offer and still be able to make the overall profit that I'm looking at. Now, again, these scenarios are a little different, so you'd have to look at that. Okay, moving down to the different scenarios. So this particular section of the calculator is strictly on fix and flips. So nothing else, but I'm planning on purchasing the property. I'm going to renovate the property, and then I'm going to sell it. Now, each one of these different sections are going to be how you're purchasing the property with whose capital you're purchasing the property with. So this first section, pretty simple. I'm purchasing the property with all my own cash, and I can tell what my overall dollar profit would be as well as my overall return on investment. So I have my return on investment for the time. Right? If I change this time, you're going to see the calculation change. So again, this is my return on investment for the amount of time that my capital is out. This is my annualized return on investment for the entire year. So if I was to just annualize this entire investment, so say hypothetically, I do 2 of these investments at the exact same return, I know that I'm going to be doing a 25% annualized return. Again, next we have section is if you are splitting your profit with a private money lender. So your private money lender is bringing in all of the capital and you're doing all of the work. You can figure out the split here. So it's pretty easy. All you're doing is you're looking at how much capital you're going to take, the percentage of the total profit you're going to take, and the percentage you're going to give to your private money lender. So this is obviously something you would need to work out with a particular lender, but here, so your private lender or your joint venture partner, you can tell what their types of return will typically be. Now, if I adjust this, I know exactly what kind of annualized return they're going to get, and I can use that as my thought process and my discussion process with your private money lender or joint venture partner. Next section here, I'm taking on a hard money loan and I'm using my own funds as the gap. So this would be the total profit I would make. Now we have different hard money scenarios on here, and I'll definitely explain that. But this would be the profitability that you would make if you used your own capital for the gap lending. Down here, same thing, hard money lender will typically be in the first position, and I'm going to use a private money lender to fill the gap funding that I would need to complete the property. Now, again, your hard money lender, they're all going to be different. Obviously, recommendation on selecting the hard money lender that works the best for you. Now, there's always a misconception that I want to get the cheapest money, but that's not necessarily the case. A lot of times people just think APR, the lower the APR, the lower the overall cost of the property will be. But again, that's not necessarily the case. A lot of it could be how much capital do I have, right? If I'm looking at scenario one is a percentage of ARV. Scenario two is a percentage of the purchase price as well as the percentage of the rehab price, and scenario three would just be a percentage of the purchase price. Now, these will be the typical layouts of what you would see from a hard money lender. And again, they could be different. But you're looking to see how much capital, right? This is going to tell me what my gap funds needs are, right? How much capital do I have availability to? And then looking to see, based off of that, what is the overall cost of capital. Now, again, it could be different. So as you can see in this scenario, that interest rates is actually higher, and I'm taking out more capital. In this, I'm taking out a loan for 304. In this, I'm taking out a loan for 320. Yet the overall total cost of capital is lower. So it all still depends. You have to take all of it into consideration. But again, the calculator will tell you, because this is what I need from the gap funding, and this is what my overall cost of the funds will be, depending on how long I plan on holding the property. Now, obviously, the shorter you hold the property, the lower the overall holding cost will be. Now, when you figure out which type of hard money lender you're going to go through, you're going to want to select there's going to be a little checkbox down here. You're going to want to actually select that checkbox, because it's going to actually work in the calculation of everything to understand, okay, which hard money scenario or which lending scenario did you actually choose. So this is really important. Now, if I look all the way at the bottom, you can get this information from Zillow. So this is a Zillow zip file, just looking to see, based off of the area that I'm looking at, what has happened with property values within the last 6 months. I can use this. If I go back up to here, I can use this to say, okay, if I'm going to have my property out for 6 months and my after repair value today is 469, predicated off of the way the market is moving, I can just select this use button, and then it's going to calculate, okay, what would my future value be depending on, again, how the market is currently trending. So again, it just depends on the overall trend. What was the highs? What was the lows? What was the month over month calculation there? So again, it gives you a better idea of the future value of the property. Now, you don't necessarily have to use this function. You can always turn it on, turn it off, and then it'll calculate accordingly. All right. Moving on to this next section. What we see is just basically based off of the ROI that you're requiring, and then it just gives you a different set of ROI. What percentage of the seller's asking price can you offer, and then what will the total overall profitability be, and then what will the offer price be? So again, you can take a quick snapshot to see, okay, based off of the profitability modules, what do I need my offer price to be? So again, just a quick, easy snapshot to see. And then you can always adjust this to a higher number, start off at a higher number, and then work your way down. And then again, as you work your way down, you'll have the different offer prices. You can, for the most part, ignore this section. Basically, it's just looking to see, it's helping calculate out the renovation cost for the particular property. So what we want to kind of pay attention to is anything with a yellow. So these yellows all have drop downs. So what we really want to pay attention to is the sections that we have yellow. So this next section in yellow is the how you would secure the debt for the property. So you can do it again, as we explained earlier, because this is going to be the outcome for any other different types of exit strategies you want to look at. So again, could be all your own cash, JV with a private lender, a hard money, and your funds as the gap, or hard money and JV as the gap. So I'll just leave it on purchasing it at your own cash. Now on the refinance, so if you're going to so you're going to try and hold the property. So again, you acquire the property with hard money, you renovate the property. Now you want to do the BRRRR strategy, or again, different options. You want to see how are you going to refi the property. Now you can secure the property, refi on a bank loan, and then you're going to want to understand what kind of a refinance you're going to do. Is it going to be a cash out refinance, or is it going to be a rate at term refinance? Again, both are important. So obviously you'd have to work that out with your lender first to figure out which type of options you have. And then you can use a calculator to figure out, okay, which is the best option for me to look at as I'm going through and looking at my different exit strategies. Now, on the seller finance, and we'll definitely get into this a bit more as well, you can actually acquire the property on seller finance, and it'll calculate out your overall expected profitability predicated off. Now, if you're doing it on seller financing, you can look to see what your profit would be, all pretty much all cash, or maybe a scenario where you're looking at your private lender coming in and you're using the seller financing as your private lender. So either way it would work, but the seller financing will be kind of important if you're looking at sort of like a BRRRR strategy. Now, on the seller financing side, the rate and term and the cash out doesn't matter. It just matters on the bank loans standpoint. So again, you're going to select the different types of how you're going to hold the property. Now, if you look to see, so if I'm just looking, so this particular section is broken off into different exit strategies. Now, in this particular section, it's the BRRRR strategy. Now, I can see as I switch between my bank financing as well as my short-term financing, I can see these numbers all change. I can see my cash flow change, my cash on cash change, my overall profitability all change. So let me switch it back just so you can see it again. Again, you can see cash flow goes up. And so it just depends on, now the cash on cash went down, but I can guarantee you that's because I have less capital in the particular deal. So let me switch it back up out again. So yeah, so you can see the amount of capital left in the deal changes significantly depending on. Again, there's a bunch of different scenarios you can adjust here, but again, this is just for the refinance. Now, down here, this section sort of ties more into the hard money loan, which I probably should explain earlier. It's just selecting to see when are the points paid and how is the percentage paid. Normally, it's going to be paid at term, so you're normally not going to adjust this much, but you can make adjustments to how points and the interest rate is paid. So some might be paid monthly, and then it's going to have a different calculation. Some is going to be paid at term. So again, this is something you're going to have to work out with your hard money lender. Again, moving on to the different exit strategies. So right here, we have 5 different exit strategies, four different exit strategies. You have your long-term, you have your short-term, you have a lease option strategy, and arbitrage and APR. And I'll explain all of these. And then I'll explain this last section as well. So a lot of these tie in together. So if I'm looking at the long-term BRRRR strategy, I'm looking to see, it sort of depends on how I'm refinancing the property. So if I'm refinancing at the bank loan, then I'm going to want to make an adjustment predicated off of the information I got back from my lender. So what is my APR? What kind of loan to value is that particular lender offering? And then you're going to see here, it's going to say LTV is less than the current debt. So that's obviously not a good thing. You're going to want to kind of be on the lookout for any prompts that come up throughout this calculator. So if my LTV is lower than If my LTV is lower than my current debt, that just means that I won't be able to, if I'm going to refinance this particular property, I'm not going to be able to pay off the first position lender. So and that will never happen. So what you would most likely have to do is adjust your offer price. And then you should see, so you see this go away. So obviously you can make adjustments to your offer price, right? It came back up, as well as my renovation costs. I could go lower on the renovation costs, and that might do it. It still all depends. It all depends on adjusting these calculations so that they make sense, depending on what you want to do. So again, looking at my exit strategy. Now, again, I'm using this as the BRRRR method. So once I figured out my refinance cost and all the terms associated there, I'm going to want to look to see what my rent, how much rent can I get for the property. So I'm gonna research that through, you can do it through Zillow, you can do it through Rentler. There's a bunch of different options you can use there. You're just trying to understand, based off of my particular property type, what kind of rent can I expect to get out of the property. I'm going to want to put some kind of vacancy. Now, every single market should have its own vacancy. So you're going to want to adjust this depending on the market that you're looking at. You're going to also want to calculate some repairs and maintenance, because again, stuff does break. You're going to need to anticipate that. And then any type of capital expenditures that you want to have a reserve for. So the capital expenditures are your larger expenses that you're just going to want to have a reserve account for. So like your roof, again, there's a life expectancy on that, water heater and see on it. The older your property is without it being renovated, the higher this amount should be, just to make sure you have enough reserves to cover you, just in case something happens. The next one is for any HOA that might exist on the property, property management. And even if you don't have property management, I would recommend using some type of number in here just to make sure you're paying yourself, because if you're managing the property, you should get paid for it. Obviously, on top of understanding that it's overall a good investment, because it's going to be important. So say one day you want to hire a property manager, you want to make sure there's going to be enough revenue to cover your expenses. So any other expenses that might incur, and then any other income that you might be able to generate off of the property, you're going to want to include here. You're going to have your overall net cash flow, and it gets a little bit more complicated down here, and I'll explain it. But what you're looking at again is, for this particular property, I'll be making $460 a month with all of my expenses incurred, and I can my overall initial cash on cash is, in this particular situation, infinite, because I pulled cash back out of the property. So I'm cashing out the property. I got a excellent deal on the property, and I'll just have continuous cash flow. Now, again, this, take it with a grain of salt. You're going to put your own numbers in here, and they're going to change as you put numbers in there. So as my price goes up, as my rent goes down, you're going to see these numbers will all change. So, and now in this particular scenario, it's a negative cash flow. Now that might not necessarily as well be bad, because I can still make money off of something that's negatively cash flowing, and I can take this as a business loss. So it just all depends on the strategy that you're looking to employ on your investment journey. Now, this next section is going to be your rental growth rate for the market. 3% is a pretty conservative standard market rent increase, but obviously this can be adjusted depending on the market that you're physically in. This is going to be your expense growth rate in the particular market that you're in. So how much is expense going up? Basically inflation. This next area is your equity growth rate. So how much has values risen over a duration of time? I typically like to look at a longer duration. So maybe 10, 15, 20-year duration, and see, okay, what is the average equity growth rate been in the market that I'm looking to acquire the property at. This next section is going to be how long you plan on holding the property before you exit out of the property. So if I want to sell the property at some point, how long in the future does that realistically look for me? And this base after that point is going to calculate, okay, this is going to be my future value of the property. So predicated off the value today being 469 and a equity growth rate of 4.2% year over year. In 10 years, the property should be valued at about $707,000. And if I sell the property with my existing debt on it, I should have an overall profit of about 340. And again, just take these scenarios with a grain of salt. You would need to put your own information in there. I know that I'm going to have a 43% compounding growth rate, a 16% IRR, and a 36% multiple. Now, you probably won't use this section below, but if for any reason during the 10 years, you say hypothetically you're in a scenario where I have a really relatively high APR, I can still acquire the property, and I know that I feel comfortable that in 3 years I can refinance the property, and let's say I can get a 4% loan, still 30%. It's then going to recalculate back out your new payments. You're going to see down here, you're going to see an adjustment to, this is the graph to kind of just show you overall my annual cash flow. You're going to see an adjustment in the annual cash flow because I'm refinancing the particular property, and I can do both a rate and term as well as a cash out refinance. It just depends on exactly what you're trying to do and how you're trying to calculate. And then it'll still calculate out your total overall profitability. Here, this would just be if you need to put in any additional capital for any reason. And there's not too many use case scenarios for this, but if you do put in a bit more capital, if you anticipate you wanted to do something in the future, it's going to calculate that out again for you. It's going to add more money back into the project, more of your calculations accordingly. The next section, I'll skip this section. This next section is your short term. Not too many other changes you'll have to make for this. It's going to calculate based off of the information you put in this BRRRR section, with the exception of you're probably going to want to adjust the rent payments because typically they're going to go a little higher. Make sure you can use a third-party application like AirDNA to get this information. You can actually also use BiggerPockets has a module connected to AirDNA for you to be able to get this information. You're going to want to include your property management because you can always self-manage, and again, same thing, I would pay yourself, but you normally are going to have a higher property management cost on your short-term rental than you would have on a long-term rental. And then again, any other expenses or any other income that you might anticipate from the property, and then it'll calculate out to see based off of my higher rent, what is my overall cash flow. And then again, what does my profitability look like? Now, you're going to typically have a little bit more capital on a short-term rental because you're going to have to include furnishings, and the calculator will automatically calculate out an estimated furnishing cost predicated off of how many bedrooms you have and the overall size of the property. So it's really looking at the size and adjusting it. So if I have a larger property, I should see my furnishing costs go up. So it just went up by about $4,000 on my furnishing cost. The next section is lease option. Same thing. Most of the information is calculated off of the long-term calculation you did earlier. All you're looking to do is put in how much am I going to sell the option for, and in what time frame I'm going to sell the option, and it's going to calculate out everything as well as your overall cash flow. And normally it's not going to adjust, so the rents are going to be your market rent. So whatever you're put in the BRRRR section, because it's not like short-term rental, it's a little different, but it is going to calculate a slight increase. So it's going to assume that you can get a slight increase over your market rent if you're allowing them to purchase the property on a lease option. And then again, you're going to see a slightly higher cash flow, less, because you're typically going to have less expenses. You're not picking up all the same expenses that you would pick up on the long-term side. And then you're going to want to see in what am I going to charge the person on the exit. So normally you're going to look to see, okay, how many years out am I going to run this lease option? Am I going to run the lease option for 1 year? Am I going to run the lease option for 2 years? And then it's going to calculate out what the future value would be in 2 years using your equity growth rate calculation. So again, going to calculate out the overall profitability for your lease option strategy, should you want to use that. This last one gets a little bit more complicated, but basically what this is you can pick up the property and then you can turn around and sell the property again, and you would be the one holding the note. Now, there's a bunch of different strategies there. This is just one of the strategies that I actually use on the exits of my rental properties or investment properties. So I included it in the calculator. So you're looking to see, when I acquire the property, how much I acquiring the property for. If I can get another buyer to pick up the property, can I expect? So we target 15 to 20% down payment on the property. So you would make that adjustment. You would make that adjustment in a dollar amount. It'll show you the percent down payment on the particular property. And same thing, I'm going to look to see, I'm going to add in some kind of buffer to see, based off of the value today, I want to see what the value would be in 1 to 2 years from now. And that's actually what I'm going to sell the property for. I'm looking to arbitrage the APR. So my APR is typically going to be higher than the prevailing APR in the market. Now, normally what we're looking at is there's going to be some type of gap here, but you can go in and you can adjust the gap. You can overwrite the number that's here. So if I change this to 8, you're going to see that go up as interest rates come down. So interest rates come down, you're going to see this number adjust as well. You're normally going to have a 30-year term. And then what you're doing is, again, like I said, you're arbitraging this. So this is what I would charge the buyer of the property if I'm trying to exit out of the property. And this, I'm going to go refinance the property back out, try to get all of my money back out of the property, and then secure it with typically you're going to secure this with an all-inclusive trust deed. You're going to have 2 different mortgages on it. You're going to have the mortgage that you're selling to the seller, to the buyer, and then your mortgage when you refinance the property back out. So again, I have the refinance terms pulling from this long-term scenario. And then the only thing you really have to add here is a monthly service fee. So I need escrow to service the loan for me, so I don't have to worry about that. Now, you don't have to put that in there. You can service it yourself. I definitely wouldn't recommend that. But if you have a loan servicer, it tells you basically what kind of capital. So I know that if I do this, I can get a $789 return from this property, cash on cash or cash flow return from this property. And my actual cash and cash is infinite because I actually pulled all my capital back out because of the down payment. Now, again, every scenario is a bit different. As you can see, this loan to current value the loan to value is less than a current debt error came back up. So again, I'm just putting numbers in here just to show you exactly how the calculator will work. Now, moving on to the other 3 tabs. There's obviously a lot less going on here, but this is how you're going to control your debt. So from a bank perspective, from the bank's perspective, the debt is handled at the top here, right? You're going to go out, you're going to get a loan. They're going to tell you how much of the ARV or the value they would loan on, and then how much your interest rate will be, and then what is the term of that loan. Here, you can adjust this on, like, especially if I'm looking at seller financing, right? So if I come back to my calculator, if I come back to my calculator, I adjust this to seller financing, and I go back here. Now I can come in here and I can adjust the APR, right? I can negotiate with the seller exactly what I want my APR to be. I can negotiate my down payment. I can change all my down payment. I have my earnest deposit. I have any type of price overrides if I wanted to just do a price override. So I can put in 350,000. It's going to recalculate. Now you see it's 340,000 because I have a $10,000 down payment. So there's a bunch of flexibility I can have with the loan that I'm picking up, especially on seller financing. I can change the balloon time frame. So when is the particular note due? I can make all of those changes, and then it's going to recalculate out the total amount that I would pay for this note and what my balance would be at the term. So at the end of 5 years, what will my balance be? I'll change it back to 10, and you can see this number will go down. Um, Down here, I can do, sorry, fully amortized, interest only, principal only, no payments, all cash, no payments, accrued interest on this particular loan. Now we'll do a few different options. I'll do interest only, principal only as an option. So what I would need to do is say how long of a term do I want this to last. Now obviously, again, you would negotiate this with the seller. I'll say if I go to interest only payments, you can see all my principal is wiped out. I'm only paying interest payments, so I'm just the interest amount now. If I'm paying interest only, you guys got to understand that my principal balance never goes down. So my balance at term actually stays higher. Now, if I switch this over to a principal only, you'll see that the overall calculation now, I don't have any interest payments. So all of my payments that I'm making is going to reduce the balance of the principal. So you can see balance at term comes down significantly. And again, all of this can be adjusted. So you can go, there's a bunch of different options that you can utilize to configure the different type of loan you're going to use. Now, I also have the option here to negotiate with seller on having them carry a second. Say I have a property that's fully, there's no particular lien on the property, right? It's owned outright, and I want to negotiate the property, and I don't want to have any cash in the deal. So I can actually pick up the property. Now, obviously, this is something you would need to negotiate with the seller, but I can pick up the property and then be able to have them secure the second loan and use the second loan as a down payment. So let's just say hypothetically, I own the property free and clear. It's a $200,000 property I own free and clear. I can go ahead and get a HELOC on that property and then pay myself, right? I'll take out $100,000 HELOC on the property and pay myself. So I'll put $100,000 in and I'll take out the HELOC and I'll pay myself and then make you, the buyer, responsible for that payment. Now, if I switch over to the second tab, I can see now I can adjust this. So say my HELOC is at 6%, it's going to adjust this number to that 6% payment. I can make whatever adjustments I need as long as my payment is high enough to cover the duration of the loan. I should be covered. And then what will happen is it's going to aggregate on when you go back to this calculator tab and I'm looking at the total cost, the total payment cost. It's going to be aggregating the payment from here, as well as the payment from here. So you're looking at two payments added up to cover the entire debt on that particular property. So again, another cool function. Just it gives you the flexibility to be super creative with the types of offers that you would be offering, and then you can still quickly see, okay, if I make this offer and if I adjust all my interest rates accordingly, what is my overall cash flow going to look like on a property that I'm holding or in the calculation. Okay, so again, there's not much else to here. You can do different things that you can add. If for some reason you wanted to add additional payments, it's just going to reduce your balance at term. So let me take this back off. You can see balance at term is 126,000. If I wanted to add $500 in additional payments, I can see if my balance at term will then drop down, and I can see I'm wanting to compare. So I have this pop up come up to see, okay, how much, if I did that, how much would I have paid monthly based off of how long I have the loan out for. So my total amount I would have paid is 60,000. So I want to just make sure that the balance at term reduced by more than 60,000, which it should. So I'm looking at 126,000, roughly So you are so roughly about $70,000 difference. So a little bit more than $70,000 difference. Okay, now moving on to this last sheet, the repair estimator. For the most part, it's relatively self-explanatory. This will give you a detailed look of your renovation. So if you're doing multiple renovations and you want to really be able to scale up, you're going to need to use some type of tool like this. Now, obviously, if I go back to the calculator, I can quickly, if I had an idea of, I know my previous renovations were at $25 per square foot, I can easily put that in there. Or if I'm just not 100% sure and I want to go to the different renovation types, I can quickly scroll between the different renovation types and it'll give me a cost per square foot. And again, this is really back of the napkin. All it's really doing is looking to see, based off of how large the property is in the square foot, this is what I estimate the renovation cost to be. Now, on this repair estimator, it's going to be a lot more detailed. It's going to give you every single segment of the property that you should be looking at for the renovation. It's going to break down how much is labor cost, how much is material cost, how much is subcontractor cost, and if I did any of the work myself, what will that savings look like? So let's just go into one of these. Now here you can open up the different segments, and then you'll have all of the details in the segment here. So if I, for any reason, wanted to, if I'm looking to do a project and I know that, so I can rekey the lockbox, I can do that myself. I'm just going to click on this checkbox, and then it's going to move the cost over to the DIY savings. So a portion of it is just going to move right over to DIY savings, and it's going to reduce the overall cost. So you should see all of these change. Now, if I take the checkbox off, it's going to go higher. I have the checkbox on, it's going to go. You're going to see it drop a little lower. So you're looking to see. This is where I would add if there's any of this work I can do myself, and if not, obviously I'll keep it off. Now, if I wanted to change, I can always add in additional tasks in here. But if I wanted to change the amount, so I say hypothetically I needed two dumpsters instead of just one dumpster, I just up the quantity amount, and then it will change the overall calculation. Or if I know that the dumpster cost is $600, right, it's going to make a adjustment accordingly. So now, again, there's a ton of different sections here. It should cover pretty much every segment that you would need in a renovation. But again, if there's something that's not included here, you can always add it and look and make adjustments to it. So say I didn't want laminate flooring, I wanted hard. I'm going to look at hardwood flooring, right? And I have different grades. I'm going to go. Okay, I'm going to look at I'm going to look at average grade, and I know I think it was 3,500 square foot, right? I can make this calculation here. Now, if my cost was a little higher than this, to say it was at $5, I can make the adjustment there, and it will automatically make the adjustments, and you'll see the changes accordingly. So again, you're going to have, this is going to be the full detailed look to see all of the different sections of the house and all of the different finishes that I can possibly put in here. And it's going to give you a full detailed outlook of exactly what the expenses are by segment. So you would literally know exactly by segment what my overall cost would be. And now obviously I can use this and I can replicate it from one project to the next project. So if I'm looking, get back into, we go framing and drywall. Now I can see the cost breakdown by room type. I can do that as well, right? I can just add a room type here, and then you'll see now that gets added to the overall cost of the room. So I can have a good breakdown by room. I can have a good breakdown by scope of work or the type of work that I'm doing in the property. And again, all of this would get fed back to the calculator here. If I select the repair estimator cost, it's going to come up with the estimator cost, as well as it's going to automatically add a 10% for contingencies, just to, again, just to make sure you have that buffer in there. But you can make adjustments to the overall pricing. So this particular adjustment here, if I make an adjustment, what you're going to see is the adjustment to the overall cost. So this is, again, probably another additional buffer in the overall cost of products and labor, just in case you're in a market where you're starting to see large increases in both product and labor. You want to be able to kind of factor it and have that as an additional overlay contingency. So again, as I make a change here, let me change this to 1 just so you can see. So now you see it's 600 here, but it's 642 here because it's adding that 7% buffer into the price that I have listed here. So this could be today's cost. And again, if I'm in a high inflationary environment, I want to make that adjustment. So I can make that adjustment here, and that will apply to the overall cost. You should see, if I make an adjustment there, you're going to see the overall cost per square foot go down, as well as the overall total estimated cost of the project. I wanted to circle back around and spend a few minutes talking about the section. I actually skipped over it when we were going through the earlier on the multiple exit strategies. This particular section is what you would use to figure out what can my offer price be for a property that's already renovated. I just want to go out into the market, buy a rental property, and see if it can cash flow. So this particular portion of the calculator will let me know exactly how much I can pay depending on how much rent I can get, what my expenses are, and what does my debt look like. So I can make adjustments as with normal. I can make adjustments to anything in yellow, and this will give me the full total overall calculation. Now, one of the things I didn't mention before is there's certain sections. If you look in this section, I can see a black triangle up in the right-hand corner. I can see another one here. If I hover over that section, it'll give me a basic description of what's going on in that particular calculation. This is, again, more maybe for future reference on understanding the sections within the calculator and putting a little bit more context to exactly what you're using this portion for. So again, I'm looking to see what can my total offer price be. Now, if my rent is lower, my offer price will obviously be lower. If my rent is higher, then it allows me to give a higher offer price. Now, again, it's trying to always maintain a positive cash flow. If for some reason I wanted to take on a negative cash flow, I could theoretically put in here, and this is an optional adjustment, and bring the cash flow down. It'll make the purchase price higher, and it'll bring the total overall cash flow down. So this, again, I can make some moderate adjustments in here. So let me just take minus 70,000, right? Again, purchase price went up a bit and cash flow went down. I can go the opposite way as well. This will take the purchase price down and my cash flow will go higher. So you're making some adjustments in here predicated off what the market is. Now, obviously the debt is huge as well, because that's going to impact what your monthly payments are, right? Or your total debt service is for the particular property. So if obviously with interest rates, if it's a higher interest rates, then you're going to see the overall amount you can pay for the property come down. And then subsequently, if it's a lower interest rate, you're going to see the available purchase price come up. The rest of these are the same as your long-term hold. And all you're just doing is updating whatever information is that you would need to put in here. Again, property management, other expenses, other income, no different than what you would have done on the Burr property. If for some reason you just say hypothetically there's a property I want to buy, it's a brand new property, but let's just say there's a basement unit in the property and the basement is not finished. I could then go ahead and actually add a bit more capital to the property to finish out the basement, and then it's going to recalculate out the total amount of capital I have in a particular property. It's going to, the same as the previous calculations, it's going to let me know how much total capital I have in the property. It's also going to let me know what my return rates are, the same profit if I sold it in 10 years. One of the things I didn't talk about in the previous is going to show me an estimated depreciation and an estimated annual annual. So this is a total depreciation over the 10 years. And assuming you took your 27.5 year standard depreciation deduction, this would be what your deduction would be on the purchase of the property. So again, being able to reduce your taxes, your taxable income. So we have all those calculations in here. And that is the end of our overall walkthrough on the calculator. Again, I wanted to just say thank you again for choosing our calculator. Your trust in the investment in this tool honestly really means the world to us. You just got to remember that smart investing is all about having the right tools and the right knowledge. And now you're well equipped with both. So again, thank you very much.